And welcome to another episode of the Durham Talents Show, where we are digging up buried talents with the infinite banking concept as conceived and described in R. Nelson Nash's book, Becoming Your Own Banker. The subject for today is when to get another policy. Now, let me start by getting a policy, because the place to start is the start. So if you are vetting this idea of the infinite banking concept of becoming your own banker, let me begin by saying that when you find yourself sufficiently aware of wanting to become your own banker, even if you have questions that you still want answered, even if you're still on your learning journey, but you are resolved to become your own banker, more is caught than taught. R. Nelson Nash always said more is caught than taught. So the place to start is by getting a policy so that you can pay premium into an entity that you own and control, wherein you can access funds to begin to satisfy whatever your need for finance in part happens to look like, regardless of whether you are a home, a household, or a business for your side hustle, for your investing, if you're an investor, whatever the case may be, however it is that you already have a need for finance, beginning to do that for yourself. So I would also like to say that R. Nelson Nash, in his book, Becoming Your Own Banker, said that he was not talking about one policy, but rather that he was talking about how to build a system of policies. So we eat an elephant one bite at a time. The longest journey is begun with the first step. Rome wasn't built in a day, right? We have all these sayings, all these ideas about getting started. So when you do find yourself in that starting position, more is going to be caught than taught. You will learn by paying those premiums, accessing your funds through policy loans to be able to satisfy some need for finance, and then repaying that, recapturing that back into your system, and growing and scaling, playing honest banker, everything that is entailed in R. Nelson Nash's book. Now, when to consider getting another policy, we are going to get to. Let me begin by saying, though, that as for me and my wife, it was not with our first policy, it was not with our second policy, it was probably not with our third policy that we used what I would call excess cash, excess funds or capital, to be able to get those policies started. I would not say that. And I'll be very open and honest about that. I don't mind being transparent about that. We didn't have money just laying around the place that we were just twiddling our thumbs, not knowing what to do with it. But we started on our journey of learning and understanding, and we were ready to begin applying the concepts of becoming your own banker. So we budgeted, we found where we could access lazy dollars that we had in other places. We found locations where we could divert funds that had previously been going to qualified plans and other things that we could deem being more productive within our control, and lots of other areas where we could start putting our capital into this entity of a whole life policy that was with a mutual company that had been paying dividends for well over 100 years and that had been properly structured for the banking purpose. So we began to pull funds together to be able to start, that first policy. And we paid our premiums as we're structured according to our wishes, because when it comes to structuring the premium mode, you have options. As the owner of the policy, you could pay annual premiums, quarterly, biannual, monthly. There are options there, and we set each of those policies. Some of them were set one way, some were set another as well, which is worth mentioning, I suppose. And we put these funds together, and we got our first policy started, and we started with a purpose. Our biggest in the beginning was to tackle a certain amount of debt that we had, bad debt, third-party debt. And I'll also interject here, we were really excited to be able to have more control over our money. We were really excited about the opportunity to not only pay off bad debt that we had accumulated, and I'll talk more about that in a second. We were excited about being able to pay that debt off, but we were yet more excited about how we could control the deployment of our funds and the recapture of those funds. I mean, if there's anything better than paying off bad debt, it's paying off bad debt and getting the money back. So we were really excited about the actual practice of the infinite banking concept, becoming our own bankers with that first policy, that second policy. So what else I wanted to say about debt, since I've brought it up, is that I do not necessarily, I would not across the board say that everyone with third-party debt should immediately jump into practicing becoming their own banker. I actually would, but knowing human nature, the human problems such as they are, I mean, Nelson Nash starts the book by talking about the human condition and all these different laws that affect us and our decisions, these emotional decisions that we make concerning money. They're not always very black and white because we are involved. Okay. And here, let me say again, I've said it many times. I've probably made every mistake that could be made in personal finance, let alone in practicing the infinite banking concept. You know, I've learned many things by committing those errors, having those faults myself. So again, I'll put that out there so that others may benefit from it and perhaps avoid some of those hurdles. You know, Nash would talk about getting the snakes and the dragons out of his life. And, you know, we've been there. We've been on that journey before. We've started that journey. So I would not necessarily, because of what we read in Nash's book, say that everyone should jump right in on becoming their own banker if they're in a debt situation. So I would, but I wouldn't. I would because when you arrive at the resolution that you want to become your own banker, of course, it does make sense. And yet we must address what I'm saying. We must address how it is that we got into that debt. What habits, what decisions, what education or lack of education. I mean, what all factors do we need to consider contributed to that indebtedness? So that's a little bit about our story. That's a little about the things that I've learned along this journey and that I would share on this channel for the benefit of others, and that we would talk more in depth about in person as you are learning and vetting and figuring more out about how to apply the infinite banking concept to your household and your business, and you're investing in everything that you're already doing. So I wouldn't necessarily say let's start with debt, tackling debt, although that's a very great thing. Again, like I said, the only thing better, in my opinion, than paying off bad debt is paying off bad debt and getting the money back. So, in considering this question of when is it appropriate to get another policy, let's consider some other aspects here. I would say that my wife and I started modestly, started small, and most people do. Most people with their first policy, even when you do finally get to serious numbers, before you get the policy, before it's issued, before you sign the dotted line, so to speak, and you own that unilateral contract, it's yours. You know, normally some eyebrows are raised. Wives have questions about, where the money is coming from, and husbands too. That's normally when you know that you're having a serious question about what your number should be. And yet, even with that being said, I know that for us, it did not take long. It probably took something like 6 months, if memory serves well, before we knew it was time to consider starting put a plan together to start our second policy. And then a third was in the future as well. So we own multiple policies with multiple companies. We're not married to any of these companies. My wife and I were married to each other, and we knew that we wanted a system of policies like Nash described in his book. And really, when we had that first policy and we were using it, we were paying significant premium. For us at that time, we were paying a significant premium, and we were accessing our cash values to accomplish some goals of paying off credit cards, paying off student loan debt, and different things that we were tackling. It didn't take us long to realize we wanted a second one. So, number one, perhaps the desire was there. The realization from having practiced with that first policy, we put it to use. We realized more was caught than taught for us in that instance. We were using that first policy, and we could more readily recognize the utility of another policy, of adding scale to what it was that we were all doing. Nelson Nash in his book uses the grocery store as an example. Well, who doesn't know of a grocery store chain that has different locations? That same store in different towns, different cities. Right. So we added scale to our system in getting our second policy, our third policy, and so on. Now, again, let me also say that I am not saying that you're going to need a new policy every month. I don't, and you probably won't either, right? Not if it's been properly structured, not if we've talked about serious numbers, not if you've done your due diligence in assessing what your goals are, where you're starting from, and several other things that we can discuss at length, or that you can learn about by diving in on the channel or reading our Nelson Nash's book, Becoming Your Own Banker, and his second book, Building Your Warehouse of Wealth. So not that you would need to start a new policy every month. Remember, I don't want you to be my banker. I'm not asking to be your banker. This is becoming your own banker. So when you have your properly structured, even your properly structured whole life policy, it should be structured in a way that it can accomplish some relatively short-term goals that you have in mind, but that is also built in a way to be able to satisfy long-range goals also. So not that you're going to need a new policy every month. And yet, Nash did say in his first book, this is to be a system of policies. So let's look at some very practical questions that we can ask to determine if it's an appropriate time to consider adding more scale to our financial footprint. One would be growing income. If your income has gone up, well, you have a greater cash flow that is coming to you now. The natural question then is, where are you going to warehouse that? What appreciating asset could you build and own and control, wherein you could still access the liquidity, the cash value, the capital that funded that entity? Well, and that's a whole life policy that's been properly structured. So if your income goes up, that would be a very opportune, pragmatic time to consider adding scale to what your system already may look like. Again, that's not to say you need to wait for a raise or for that next big job or for, some windfall money. Although windfall money, that's another great example. There are lots of different examples. And actually, that could be one. Because, again, when you do arrive at the decision to become your own banker, you start where you start. You start where you are, not where you may be or will be or should be. Okay? You can start where you are. And that's even without a policy. Can you practice the infinite banking concept with a mason jar? Well, sure you can. I wouldn't necessarily describe a mason jar, obviously, as having the abundance of characteristics that a whole life policy with a mutual company does. Dividends and tax-free and tax-deferred advantages and protection against litigation and inflation and appreciation. market volatility, all these different characteristics and attributes of a whole life policy. And yet you can practice the infinite banking concept with a mason jar. So when income goes up, that's a great opportunity to assess whether you should add scale to what it is that you are already doing. So if you're a client and you have, an investment come through, you get a new big job contract, etc., you have some new residual or passive income begin to flow to you, you get the raise at the job, whatever the case may be. If you have that increase in income, that's a great opportunity to be able to look, have a discussion, consider whether you should add scale to your financial footprint, your system of policies. Another great example would be when expenses decrease, right? So like when the income goes up or when the outgo goes down. If you've traditionally had some big overhead in a business, for example, and that either gets paid off or, well, that could open up funds that now could be more productively directed towards a new policy. Now, also, let me say this. That could also mean that if you have outstanding loans with current policies, you could fill that space up there. That way you have capital again, because remember, when you systematically and purposefully set aside capital, Nash would say in his book that opportunity will hunt you down. Okay, so if you have an outstanding balance at that particular moment in other policies, you could fill that up. You could load that warehouse up, right? You can, if your policy's been properly structured, you can check with the insurance company to see if you can get some extra paid up additional premium paid. So lots of different options there. So consider your financial footprint as it is, but getting a new policy, adding a new policy to your system if it's the appropriate time to scale, and some big expense. When I say big, it doesn't have to be big, but when an expense is now off the table that had been very regular for you or systematic, it's a great opportunity to be able to assess whether now you should add another policy to your system. And then let me also say a very pragmatic example would be based not just on your income or your expenses, but on the people themselves in your life. So if it's a household and the household has a new baby, that's a great time to be able to, again, if it's appropriate, if it makes sense, to be able to add scale to your banking system at that time. But a new family member is a great time to be able to minimize underwriting. There's going to be a lot less that needs to be done in underwriting the policy for an infant, a child in their first month of life, than for a 20-year-old, 30-year-old, 40-year-old, 50-year-old, 60-year-old, so on. So that would be a great opportunity to be able to add scale to your banking system. And there are lots of benefits there. In the business world, it would make sense to consider having a policy on pertinent, crucial and key either employees, business partners, if there's a business relationship where ownership is shared, having a buyout option because of a tax-free transfer of wealth from a death benefit would greatly ease the transition, not in any other way other than financially, of course. But if somebody were to have an early graduation and there were a death benefit that could ease the business stress financially, or even the family situation, then that's great and reasonable and becoming. So business partners, key employees, and some other situations there. So if that's a question that you have where you'd like some further guidance or consideration we can definitely have a conversation about that. So I hope that this information has been helpful in answering the question more on when's the appropriate time to get another policy to add to your system. But if you'd like to carry the conversation on, call 828-817-4223, or you can email durhamtalents@gmail.com, and I look forward to that conversation. I hope you have a great day. Take care. Hello and welcome to another episode of the Durham Talent Show, where we dig up buried treasure we're not digging up buried treasure, we're digging up buried talents.